Nokia stock is currently trading at 14.46 on the NYSE as of May 15, 2026 at 12:28 p.m., showing an intraday decline of 1.70% from the previous close. While the surface-level numbers might suggest a minor retreat today, the reality sitting just beneath the tape is far more aggressive. Most people look at Nokia and still see a legacy hardware player struggling to find its footing in a saturated mobile world. But that specific expectation is being shredded by a massive shift in institutional positioning. If you were only watching the ticker today, you missed the fact that Nokia just hit a fresh 52-week high of 15.19 yesterday, and this minor pullback is essentially a breather after an absolute tear that saw the price climb over 35% in less than a month. The curiosity here isn't about whether they can survive, it's about how they've suddenly become a primary beneficiary of the hardware needs for high-performance computing. We are seeing a complete reevaluation of what this company is worth, and the gap between the old telecom narrative and the new infrastructure reality is where the biggest opportunities are hiding. When you look at the daily swings we've witnessed recently, the volume tells the real story. Just 2 days ago, we saw over 145 million shares change hands, which is more than double the average daily volume. That doesn't happen because retail traders are bored. It happens because big money is moving in. We are seeing major banks like JP Morgan and Morgan Stanley drastically hiking their price targets, and the reason is almost entirely tied to a segment of the business that used to be a footnote. The AI and cloud segment grew by a staggering 49% in the first quarter of this year. While the general market was distracted by the usual suspects like Nvidia stock or Apple stock, Nokia was quietly booking 1 billion euros in orders specifically from cloud customers who need the optical networking and IP routing gear that Nokia excels at. This isn't just about 5G towers anymore. It is about the physical plumbing of the internet that has to be completely rebuilt to handle the massive data loads that come with generative AI. The trading activity lately has been characterized by a stair-step pattern, where the stock pushes higher, consolidates for a few days, and then catches another wave of buying. This is a classic sign of institutional accumulation. Dip buyers have been incredibly active every time the price touches a support level. If you're using platforms like the Robinhood app or Interactive Brokers Trading, you might have noticed the volatility has spiked, but the trend remains firmly upward. The market is now paying a massive premium for Nokia, with a price-to-earnings ratio sitting near 90. For a company that used to trade like a value play, this is a total transformation. It's no longer about finding deep value in a forgotten name. It is about paying up for a growth profile that the street finally believes in. We're seeing a shift where investors who typically look at self-investing or use intelligent portfolio services are starting to see Nokia pop up on momentum scanners rather than just dividend yield lists. I want to pause here for a second and get your take on this shift. Comment below how many shares of Nokia you currently hold, or if you're looking at other networking names instead. It's interesting to see if the sentiment in the comments matches the aggressive buying we're seeing from the big funds. Establishing the common ground here, the general belief for years was that Nokia was stuck in a perpetual turnaround. Every time they'd have a good quarter, the mobile network segment would drag them back down. But the reality now is that the mobile networks are stabilizing, and the growth in optical networks is so explosive that it's masking any minor weaknesses elsewhere. They recently raised their 2026 growth guidance for network infrastructure to 12 to 14%, which is double what they were expecting back in January. This is what creates that tension I mentioned. The market narrative hasn't fully caught up to the fact that Nokia is now an infrastructure play for the largest tech companies in the world. They are winning design wins for high-speed data center interconnects, which is the same space where firms like Arista or Cisco usually dominate. But Nokia is coming in with a tighter, more efficient solution that is gaining traction with hyperscalers. To understand how we got here, we have to look at the business model. Nokia makes its living by selling the hardware and software that lets data move. This includes everything from the massive fiber optic cables that run under the ocean to the small boxes that provide 5G signals in a city center. They also have a very high-margin technology licensing business where they own thousands of patents related to wireless communication. Every time a smartphone company sells a device, there's a good chance they are paying a royalty to Nokia. This provides a baseline of cash flow that allows them to invest heavily in research and development. In the first quarter of 2026, they spent over 1 billion euros on R&D alone. That's the kind of spending that keeps a company relevant when the technology cycle shifts as fast as it is right now. They aren't just reacting to the market. They are trying to build the next generation of indium phosphide chips in their own manufacturing facilities in San Jose to stay ahead of the curve. Looking at the financial health, the balance sheet is surprisingly clean for a company of this scale. They have a net cash position of about 3.8 billion euros, even after paying out dividends. This gives them the flexibility to make small strategic acquisitions or buy back shares if the price dips too far. We've seen them pruning their portfolio recently, selling off legacy businesses like fixed wireless access to focus more on their core strengths in 6G and defense.
This discipline is something institutional investors love to see. It shows a management team that isn't trying to be everything to everyone, but is instead focusing on the high-growth, high-margin areas of the market. While people are busy looking at the Robinhood crypto charts or checking their Fidelity brokerage accounts for the latest meme stock, Nokia has been putting in the work to become a foundational piece of the modern digital economy. The future outlook for the rest of 2026 is where the real tension lies between the bulls and the skeptics. The bulls are pointing to the massive order backlog and the fact that the AI supercycle is only just beginning. They see a world where every data center needs the kind of 800 gigabit and 1.6 terabit networking that Nokia provides. The skeptics, however, are worried about the valuation. Trading at 90 times earnings means there is very little room for error. If they miss a single revenue target or if the cloud spending slows down even a little bit, the stock could see a sharp correction. This is why the intraday movements are so closely watched right now. We are in a phase where the stock is priced for perfection, and every piece of news is magnified. Another catalyst to keep an eye on is the expansion into the defense sector. Nokia has been working with Lockheed Martin on 5G solutions for military applications. This is a completely different revenue stream that isn't tied to the typical telecom capital expenditure cycles. It's a recurring, high-secure business that could provide a massive tailwind over the next few years as governments realize they need private, secure networks for their operations. This is the kind of insight that the average investor might miss while they are just looking at the headline earnings per share numbers. It's the combination of the AI cloud growth and these strategic defense partnerships that makes the long-term case so compelling, even if today's price action is a bit choppy. For those managing their own investments through platforms like SoFi Invest or Schwab Intelligent Portfolios, the question becomes where Nokia fits in a diversified book. Is it still a boring utility-like stock, or has it graduated into a high-growth tech name? The current price action suggests the latter. We are seeing a complete re-rating of the stock's multiples. If the current momentum continues and they can deliver on the raised guidance for the second half of the year, we could see another leg up toward the target some analysts have set in the 18 to 20 range. However, we have to stay grounded in the reality of the macroeconomic environment. Interest rates and global trade tensions still play a huge role in how much these big telecom providers are willing to spend on new equipment. In the end, the story of Nokia in 2026 is a classic example of reality finally exceeding a very low set of expectations. For a long time, the expectation was that this company would slowly fade away as it lost market share to cheaper competitors or more nimble startups. Instead, the reality is that they have carved out a dominant position in the most critical parts of the global network. They have turned a legacy into a platform for growth, and the market is finally starting to reward them for it. Whether you are using a Fidelity trading platform or just keeping an eye on the news through your phone, it's clear that the old Nokia is gone, and what has replaced it is much more formidable. The authority they are building in the optical and cloud space is real, and it is being backed up by billions of dollars in new orders. As we wrap this up, the central takeaway is that the intraday decline we're seeing today is likely a distraction from a much larger structural trend. The expectations for the company have been reset, and while the stock is no longer a cheap bargain, it has become a necessary piece of the conversation for anyone interested in the infrastructure that powers AI. We've seen a massive shift in how the street views this name, and as long as the cloud orders keep rolling in and the defense partnerships continue to develop, the long-term trajectory remains tilted to the upside. The contrast between what people thought Nokia would be and what it is actually becoming is the primary driver of this current rally. Make sure you stay focused on the volume and the institutional activity, rather than just the daily price changes, as that is where the true intent of the market is revealed. This has been a detailed look at the current state of Nokia, and as always, the key is to balance the hype with the hard numbers on the balance sheet. Authority in this market comes from knowing the difference between a temporary trend and a structural shift, and right now, Nokia seems to be firmly in the middle of a shift that will define the networking space for years to come.